Hello friends, last week was something most traders will not forget. So won't I. But if you had watched my video last week, you shouldn't have been taken by surprise. In this video, I'm going to take up where I left off from last week and I'm going to clarify a whole lot of doubts that you might have about what to do in the week ahead. I'm Vijay Bhambwani. I've been trading these markets since 1986 and my videos are all about keeping you ahead of the crowds and giving you the kind of data and statistical analysis that the media, the fund houses and the brokers will never be able to give you. Let's dive right ahead and see what lies ahead of us in the market. On your screen is the market roundup window. And what you can see is that the Nifty and the Bank Nifty both fell over 5% last week. Of course, the Nifty took it on the chin and fell a little more than the Bank Nifty. And we saw a general tendency to unwind positions. Now, whether it was bullion, which is deemed to be a safe haven, or it was crude oil, natural gas, and we saw a panic in the market that basically turned traders into a risk-off mode. Risk-off mode is when you don't want to take any risk and you find safety when you convert your holdings to cash. Now, the one good thing that happened on Friday was crude surrendered a whole lot of ground in one trading session. Of course, it was not the only day that it fell, but Friday's fall has been humongous. And this is something many veteran viewers of mine, especially those who've been watching my views on Equity Masters channel as well, that I have been a skeptic of the whole super cycle theory in commodities. I've also said that natural gas went up only because it was weaponized as a geopolitical weapon, and so did crude oil because all the producing countries have come together to create a man-made shortage of oil. And there you have the prices coming down, which is likely to be a very major reason why there has been optimism in the markets. And all this talk about market approaching a short-term bottom stems from the fall in crude oil. The US dollar index continued its rally at 0.44%. It basically managed to stay above the 104 levels on a week-on-week basis. And the United States dollar also gained against the rupee as we see a near quarter percentage point rally in the dollar versus the rupee. Now that is what kept our markets on the tenterhooks. The 10-year Indian benchmark bond yields continued to rise and at 7.58%, they are at the upper end of the range that we've seen in the last few quarters, and we are basically now at a multi-year high. And chances are that the bond markets, which are fearing either a rise in inflation from the present levels or maybe even a rate hike in the coming MPC or the Monetary Policy Committee meeting in August. The NSE lost 6.01% in market capitalization, and I've told you before, if we see more than 4 to 4.5% loss in capitalization for 4 consecutive weeks or maybe 5 consecutive weeks, a bear market has invariably followed. Now, we saw a respite very briefly, but the decline has started all over again. And what a decline, a straight 6.01% fall. Do keep very keen eyes on this metric. MWPL continued to rise, which is normal till the third week of any derivative expiry, and we saw a 27.01%. I'm going to cover this in a slightly more detail. And the US markets continued to fall. And like I pointed out to you last week, the fall is noticeable to the extent that the broader the index, the more the decline. So the narrowest index, the Dow Jones Industrial Average, fell 4.79. A somewhat broader index, Nasdaq 100, fell 4.79 again. But S&P 500, the broadest index of them all, has fallen 5.79%. Now, this is one reason why many emerging markets witnessed a decline last week. Let's take you through the US market indices. This is the Dow Jones Industrial Average daily chart on your screen. You can see that the death cross, wherein the 50-day moving average trading below the 200-day moving average, still remains in place. No change there. And what we are seeing is a long leg doji, where the open and close are somewhat in the center of the intraday range, and the range is fairly wide. There are long shadows both on the up and down sides of the real body of the candle, which shows indecision and a possibility of resistance to further declines. So, the US markets are shut on Monday for Juneteenth, Independence Day. So, we are not going to get any kind of triggers from the US market on Monday, which makes the possibility of high volatility in the Indian markets as a very real outcome. The Nasdaq 100 chart actually shows the index gained on Friday, and the death cross on the Nasdaq was seen earlier than the Dow Jones Industrial Average. So the possibility of it attempting to hit bottom and regain some of its lost ground also remains fair. Now the S&P 500, which also gained very slightly on Friday, and it also shows a long leg doji here on your chart. The price is far away from its moving averages, the death cross confirmed. So mean reversion, which means a slight pullback rally, could be in the offing. And if there is a slight pullback rally in the US, can there be a possibility of a pullback rally in India? I would say that possibility remains open. We come to our own Indian market, our in-house indicators. We are seeing the MWPL chart on a daily compression basis. We've reached 27.01%. I've told you in my earlier videos that in the third week of November, that was the last time we saw 35% MWPL. Now, what is MWPL? The limits that are set by SEBI of maximum exposure, and the MWPL measures the percentage of the entire permissible limit being utilized by traders. So we have utilized 27.01% of the entire market permitted MWPL, and this is indicating a low risk appetite. 35% was last seen in the third week of November, and we've only come down. So the two Marshmallow traders are showing compression and risk appetite. The Marshmallow theory is explained in this video. The hyperlink to it is in the description and in a pinned comment at the end of below this video. Let's take the MWPL chart on a week-on-week basis. We are seeing that in the run-up to expiry of the June series, we are still meandering around at 27.01%. Not too much of a possibility of a big ramp up in MWPL in the week running into expiry. So I think we are going to make a lower top on the MWPL this week as well, this derivative expiry as well. Now, stock and index futures turnover. This figure is cumulative of three derivative series. So June, July, August. What we are seeing is the index futures turnover was higher as compared to last week, and so was stock futures. That tells you something. That tells you that one Marshmallow traders, remember the Marshmallow theory is explained in the hyperlinks below, the one Marshmallow traders were comfortable selling. That tells you that there was actually selling participation, which is why the markets went down with goodish volumes. And when selling pressure is fairly high, two things occur. Number one, high volatility, because emotion-based positions are built up, and either those positions result in good profits wherein they are squared up, or they result in disappointment and they are surrendered in panic, which again triggers higher volatility. So, this kind of high volumes in a week where volatility was high tells you that it could lead to even higher volatility in the coming days. Now, the same stock and index futures turnover chart on a weekly compression period. What we are seeing now is that the turnover is somewhat in the upper end of the average range in 20 weeks. That's 4.5 months. Now, this kind of volatility and this kind of participation can only mean one thing. Like I said, high volatility ahead. Now, we turn to the basis analysis. What is basis? The premium enjoyed or the discount suffered by the traded security over the spot price. Where the basis is concerned, it's a gauge of two Marshmallow traders and it tells you what the risk appetite metrics is as of now. So the daily chart on your screen tells us that the basis rose on a week-on-week basis on the Nifty, which also flitted around in inversion zone, which is discount to cash. Whereas the Bank Nifty is concerned, the basis was lower than the previous week because selling pressure was seen at higher levels. Friends, in this video, there is a special, very brief segment of whether I would short the markets in the coming week. I share my 2 bits like I did in the video mid last week about my short-term game plan now that interest rates are higher. So stick around with me till the fag end of this video and do watch that segment, which is demarcated as a separate chapter. Now the basis chart on a weekly time frame, 20 weeks look back at 4.5 months. What you are seeing is that the Nifty basis has risen on a week-on-week basis, marginally that too, whereas the Bank Nifty basis has actually come down on a week-on-week basis. So there's selling pressure at higher levels on the Bank Nifty, whereas Nifty 50 there has been some amount of short covering at lower levels, which is what leading to expectations of a short-term bottom in the markets with a possibility of some pullback rally. Let's now take the advanced decline ratio on a daily compression basis. This is a one Marshmallow metric, and what we are seeing is barring Wednesday where the advanced decline ratio briefly went above 1, we have stayed below 1. Now, what is the advanced decline ratio? It basically measures the number of shares rising vis-a-vis the number of shares falling. All right. So a ratio of 1 tells you that for every 100 losers, there are 100 gainers. And staying below 1 tells you that there are more losers than there are gainers. So all of last week, barring Wednesday, which turned out to be a trap, we have seen a very poor buying conviction. The same chart seen on a weekly compression basis, it tells you that you're almost kissing the lowest end of the 20-week range of the advanced decline ratio, which means risk appetite is almost at a 4.5-month low. This is not exactly good news for the bulls. Now let's check the impetus of the Nifty and Bank Nifty chart. Now this is something that you have enjoyed, trusted, banked upon and traded with a great degree of trust and enthusiasm, and it's lived up to your expectations. Now, this is an in-house exclusive indicator, not available anywhere else in the public domain. What is very striking is the fact that the Nifty and the Bank Nifty impetus has jumped to a period high in a 20-day time frame daily chart. This is something, my friends, that I had warned you last week as well, because the impetus was down and I told you, don't be surprised if the impetus leaps up and it leads to very, very high volatility. And that's precisely what this very reliable, bankable and trustworthy indicator did really warn us about accurately. Taking the impetus chart on a weekly basis, we see that the Nifty 50 impetus is nearly at a 4-month high, whereas the Bank Nifty impetus is marginally lower than the all-time high of a 4.5-month period. What does it tell us? It tells us that the possibility of the impetus easing also exists. The fact that impetus has hit a very high note and it could ease tells you that continued declines might be on lower conviction levels. That leads you to a possibility of a very brief attempt by the bulls to form a short-term bottom. And if the rally also occurs and the impetus is easing because it's at the upper end, it means the rally will be a weak one. Either ways, this is not indicating that the bearishness in the market is over. It's only telling you that there could be a correction in the impetus itself, not a trend reversal in the market. Now, the LWTD, the lift, weight, thrust, drag indicator, the latest in our weapons that we've shared with you in the last couple of months. Now, the lift, weight, thrust, drag indicator is indicated as a red line, whereas the Nifty percentage gain or loss is indicated as a blue line. What you are seeing is that the Nifty percentage gain loss is showing a higher bottom, which are marked with two blue arrows here, but it remains below zero. So there has been a calibrated attempt by the bulls to resist declines. This is something that I have been sharing on my social media accounts, as well as the Telegram channel, which you can join. My contact coordinates come at the fag end of this video, also in the description and in the pinned comment below this video. So I talked about a hope-based up move. Hope is still alive in the markets, and which is why the Nifty percentage gain loss line is making higher bottoms. The LWTD on a daily chart has fallen on Friday. No surprises there, because Thursday and Friday were extremely nervous days for bulls. So the outlook, which is indicated for Monday by the LWTD chart, is that sure enough, there might be hope-based buying because the blue line is edging higher, but higher levels will see a flight to safety and overhead supply. What is overhead supply? When the market starts to go up, guys who bought at higher levels are saying, okay, my break-even point is come, so I'm going to get out at no cost. I mean, no profit, no loss. That overhead supply might rule the roost on Monday. Do remember, crude oil has fallen late night, late evening after our markets have shut. So that factoring in, if at all, will take place on Monday in our markets. The LWTD chart on a weekly compression basis tells me that the Nifty percentage gain loss as a blue line is attempting to go up after having hit almost the lowest in 4.5 months, but still remains below zero. And the LWTD is now sinking below zero again. Do note how many times in the last 6 to 7 weeks the LWTD has closed below zero. The longer it stays below zero, the more weeks it stays below zero, the more kind of declines you're likely to see in the markets. Now, I take you through the footprint of the four different types of participants in the market. We start with the FIIs, and what we are seeing is that FIIs have shown a lower conviction levels, which is why their net long positions, which is long minus short, in both indices and index futures, have fallen on a week-on-week basis. FIIs, of course, have been relentless where their selling pressure is concerned. Let's take a look at DIIs, the domestic investment institutions. Surprise, surprise, their index futures have gone into net positive after being net negative for many, many months. The individual stock futures, of course, remain net short, and not only net short, but they've increased their net short. So their outlook on individual stocks is more negative as compared to last week, which is why there's a down arrow here. So for the first time, they're basically banking on the indices going up, which might be indicating of a technical rebound. Now for prop traders, these guys are second best only to insiders because they are brokers' own trades. They know who's buying, selling, and how much, at what price, and their exposure therefore becomes important to gauge. What they have done is increase their net long exposure in individual stock futures, whereas their index futures net exposure is basically down a little bit, which is why there's a red arrow up and a blue arrow down. Now, for the retail guys, these guys have been doing all the heavy lifting. They hold the largest amount of long exposure in the market. So their actions can call the shots about short-term price trends. Where the individual stock futures are concerned, they've raised their net long positions on a week-on-week basis. They're showing a higher degree of enthusiasm. But where indices are concerned, they have reduced their net long positions on a week-on-week basis. So you have a situation where prop and retail are actually standing head-to-head, nose-to-nose against the FIIs. They are taking on the FIIs. Now, who will win is something that the future couple of days will tell. Friends, I'm sharing another study with you for the first time. This is the Nifty futures in indicated as a purple line, and the index options turnover indicated as a red line. Do note every 5 trading sessions you're seeing a dip in the options future turnover. This is nothing but the day after the weekly index options expiry, which is Friday. Expiry is on Thursday. Their declines are made on Friday because till then, people tend to be gung-ho and they create fresh positions. What you are seeing, this is a daily chart, of course, but when I look at the monthly and weekly chart, I see that the turnover in index futures is going down and exposure in index options is going up. Now, to somebody who's not really very savvy or has not spent too much time in the markets, they would say, hey, Vijay, how does it matter? At least these guys are buying, right? So why are you so finicky and particular about whether they're buying futures or they're buying options? Well, the point is that it indicates risk appetite. It takes conviction, it takes money, and it takes deep pockets to go out there and commit money to futures. You have to write out a span margin check. Whereas buying call options doesn't cost as much money. So to that extent, traders feel they are cheaper. Now what is happening is either because they've lost money in their long positions or they lack conviction or maybe even both, they are shifting from futures to options. If this situation continues, it tells me that the markets are in extremely desperate and weak hands. So maybe a short-term bottom may be made, but this is definitely not a trend reversal into a bull market. Do remember, I promised you I have recorded a special segment at the fag end of this video as to whether I would go short or not in this market. The daily indicators done, I come to the bond market, a very critical market here, as you would have realized by now. What the interest rate markets do impacts equities, and we are at the forefront of covering bond markets for you since many years. Earlier, when my weekly market outlook was in a PDF format, I used to begin the report with the bond market outlook. Now, of course, since a year and a half, we are recording videos, and I have always told you, ignore the bond market at your own risk. Do not let anyone tell you that it's not important, especially if you're a Bank Nifty trader. Because the bond market impacts banking stocks and Bank Nifty immediately, and it's indicating nervousness. As the weekly chart on your screen tells you, the 10-year Indian benchmark bond yield is at a multi-year high. And it's talking about a potential rise in inflation and possibly even further rate hikes in the August Monetary Policy Committee meeting, which is coming forward. That means that all companies that are dependent on EMI based sales, that are dependent on leverage buying, are likely to see their stock prices go down, and banking might just remain marginally under pressure. So, do not ignore bond yields. Always keep your ears to the ground and observe the bond market. Friends, the bond market done, I now come to the US dollar index. Now, this is a very critical aspect of the market because for all emerging markets, including India, the US dollar determines inflation. How? Because import dependent countries like India, and two-thirds of all our imports are fossil fuels, when the dollar rises, the landed cost of goods is higher, and that leads to imported inflation. The dollar denominated debt in foreign exchange that companies and India itself has taken becomes more expensive to service, which is why the US dollar index matters. Don't let anybody tell you, in addition to the bond market, that you need not monitor the dollar while trading equities or commodities. So, what we saw was the US dollar index continued its up move, as you can see on your screen. It rallied on 3 out of 5 trading sessions, and the price basically took support at the 25-day exponential moving average, which is a proxy for a month-long holding on cost of an average bull. So the short-term outlook remains positive for now. When we take a look at the weekly chart, what we see is a long leg doji kind of a candle here. Not perfect, but something of that sort, which tells you that the open and closed were fairly close to each other, and long shadows or wicks at higher and lower end of the range of the week. That tells you indecision. There was a lot of tug of war between the bulls and bears, but finally what happened was that the open and close were fairly close to each other. Now, what really happens at a tug of war kind of an outcome like this is that a breakout or a breakdown has to be seen above the weekly high or below the weekly low for the fresh next trend to begin. But remain assured, the price remains above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook still remains bullish, which means pressure for emerging markets on the whole. Now, in the week gone by, I had recommended or advocated estimated range between 105.75 on the upside and 102.60 on the downside, which held perfectly well. In the coming week, I expect a range between 106.30 on the upside and 103 round number on the downside. Friends, the US dollar index done. I now come to the Bank Nifty, which is in the eye of the storm. What with all the bond market signals, rising interest rates, inflation data, and the currency volatility is concerned. What you are seeing is the daily chart on your screen, which tells me that after falling 5.05%, the Bank Nifty logged falls of 3 out of 5 trading sessions. Do note how the gains shown by very small green bullish candles are tiny compared to the humongous losses. I've marked the gap with which the index opened on Monday. It's a lower gap. And note how the Bank Nifty has also confirmed a death cross, which I marked with a red arrow on the screen. We are currently poised near the 8th March 2022 low, which was at 32,155 levels. That is where a semblance of support is likely in the immediate term. Now, will this support hold? A million, billion, trillion, zillion dollar question. We don't know yet. So let the market tell us whether the 32,100, give or take a little bit here for emotional turbulence, is it holding or not? If it is violated and the index trades comfortably, sustainably below this level, we are going to seek fresher bottoms. But if it doesn't, in the absolute near term, the attempt by the bulls will be to fill this gap which you are seeing on your screen, which is a bearish gap left on the Monday's open, might be attempted to be closed. In which case, there would be a mean reversion, technical pullback, dead cat bounce, corrective rally, call it by any name you want, that could become a distinct possibility. The price remains below its 25-day exponential moving average, which tells me that the month-long holding on cost of the bull is upside. And here again, selling at higher levels from overhead supply. People who are trapped at higher levels will attempt to get out at break-even prices. The weaker hands are nervous and they are likely to try and sell. Going to the weekly chart, what we are seeing is that the price remains below its 25-week exponential moving average, which itself is now beginning to keel over. And that tells me that this is the first big serious correction after the rally started in end of March 2020. And we've seen 3 consecutive weeks of declines as the three red candles tell us, and upsides like I told you. The closer you get to the moving average, 25-week moving average, the more you're likely to see declines from overhead supply. Now, in the week before last, this index was at number 6 on the most volatile list that we maintain in-house. Last week, it jumped 4 notches to be at number 2 on our watch list. Now, a big index, a frontline index like the Bank Nifty being at number 2 on the most volatile list does not augur well for an average retail trader, because volatility will be far too high compared to their risk appetite. And last week, I advocated a range between 36,150 on the upside and 32,800 on the downside, which was admittedly violated because of the huge volatility. It saw a low of 32,290 in the spot, which is approximately 510 points lower than what I thought it would. In the coming week, I expect an estimated range between 34,425 on the upside and 31,050 on the downside. Can these ranges be violated? A very strong probability exists that they might be. Do remember that the Bank Nifty has moved up 4 notches on the volatility rankings. So anything is par for the course. The Bank Nifty done, my friends. I come to the Nifty 50, which fell 5.61% on a week-on-week basis. And what's noteworthy is the fact that this frontline index, which is the most liquid, lowest impact cost traded instrument on the NSE derivative segment, it fell on all 5 out of 5 trading sessions. There was no respite for the bull on any single day. That's the kind of selling pressure that we saw. Here again, the index has left a gap on the downside on Monday, and that gap has a potential of attracting the prices like a chaotic attractor. The bulls might attempt, whether they'll succeed or not is besides the point, the bulls might attempt to close this gap. The death cross on the Nifty itself also has been confirmed, slightly later than the Bank Nifty, but confirmed. And here again, we are at the 8th March panic low, which was, we are below the 8th March panic low, which was at 15,671. Now, on the upside, this level might act as an immediate resistance, because as per technical analysis, a violated support becomes a resistance on the up move. So as and when markets attempt to rise, The first resistance for the Nifty spot will be 15,670 odd levels. Now, since the price is below its 25-day exponential moving average, which is a month-long holding on cost of an average bull, the short-term outlook has been vitiated. Here again, overhead supply coming in from traders who are trapped at higher levels. So upsides will meet resistance. Let's move to the weekly chart, and we see lower tops being made in October, January, and March. I told you last week that not only are there lower tops in the market, but the top made in October was followed by a bottom which was violated in the second bottom after the January top. And if 15,500 was to be violated, you're looking at a significant lower tops, lower bottoms formation. And here you have it. The previous swing low of 8th March has been violated. So not only are you seeing lower tops, but a third consecutive lower bottom. Unless the Nifty stay above its 8th March panic low of 15,671, consistently stay above this, I think the bulls are likely to be under pressure. They are likely to be on the ropes, and they will continue to feel the heat. So the trend reversal is not done. It is possible that a technical pullback rally occur. A short-term, a very short-term workable bottom might be made for mean reversion basis, for short covering basis. But am I expecting a complete bull market reversal into sentiments now? I don't think so. That's borne out by the fact of the volatility rankings. Our in-house volatility ranking showed the Nifty at number 15 last week, in the week before last. And last week, it rose 8 notches at one shot to go to number 7. Now, this is not healthy for a frontline index at all. This kind of volatility simply means that an average retail trader is unable to be able to make money trading the markets day in and day out with the kind of ease that he is used to just 2 or 3 months earlier. Last week, I advocated a range between 16,800 on the upside and 15,600 on the downside, which was admittedly violated, the low being 15,294. Now, that's a good 306 points. In the coming week, I expect a range between 15,925 on the upside and 14,650 on the downside. The range might appear wide, but do remember, volatility has gone higher, and therefore the base effect of statistical beta being high, the ranges by a statistical model, the IBEX, will also appear to be exaggeratedly wide. I'm not trying to cover my ass by deliberately giving you a very wide range. This is just a form and function of statistical beta. Friends, the indices done. I now come to the most popular aspect of the market, wherein I give you 5 stocks that have gained the most in impetus, and therefore you buy small quantities, wait for large price move, and 5 stocks that have compressed on impetus on a week-on-week basis, day-on-day basis, where you take bigger exposure, wait for small price moves, and take your scalp trades. Why the difference? Because different traders, different mindsets, attitudes, and aptitudes, therefore different approaches in the market. Now, the high impetus gainers list is led by Aditya Birla Capital at number 1, number 2, IDEA, number 3, Aditya Birla Fashion, number 4, Bharat Heavy Electricals, BAIL, number 4, Bank of Baroda. The impetus losers list is led by Shree Cements at number 1, number 2, Page Industries, number 3, Ultratech Cement, number 4, Whirlpool, and number 5, Honeywell Automation. Friends, this hierarchy of stocks changes hour to hour, day to day, which is why it's updated every day. This particular list is valid only for Monday. Should you want updates for what to do on Tuesday through Friday, do request to be included in our Telegram channel. You can join in our Telegram channel. The hyperlink is in the description and the pinned comment below. It appears in the contact coordinates at the fag ends of this video. We also WhatsApp the same to you. The contact coordinates appear as usual. Now, friends, for the promised last segment, would I short in the coming week? The simple answer is yes. I will seek to attempt short selling opportunities, but it will not be my eyes closed like I was comfortable shorting in the week gone by. I would want to take a slightly calibrated approach. I would want to wait for rallies before shorting, because the kind of declines, gap down declines that we have seen in the week gone by make it probable that there could be pullback technical bounces. I'm not saying that a bear market is over and a bull market has immediately begun. All I'm saying is that no trend, whether downtrend or uptrend, is as straight as a foot ruler. There are jagged moves in between, and we might be possibly, we don't know yet, in the middle of a jagged move which could catch us on the wrong foot. So why not attempt to sell on advances rather than just sell at any given price at open? The other thing, like I mentioned in this video, my trading strategies in a bear market, which I made in the middle of last week, I would want to target those stocks where hope has risen significantly over the last few days, and those hopes are likely to be dashed. I want optimism and greed to be replaced by panic and fear and disappointment, because that is where people will surrender their positions the hardest and the fastest, and the falls will be the most pronounced. So I will use statistical analysis. I will choose only those stocks and those counters where MWPL has risen the sharpest on the way up. This is where people are holding and nursing a lot of hope, and this is where disappointment can be the highest. This is my game plan. Very simple. Yes, I would short, but at advances and only those counters which are carrying a lot of baggage. Now, the guys that are carrying a lot of baggage are the first to kind of fall out of the sky when the adversity hits. As you can see, we have a game plan ready. If there are problems in the market, if there are challenging situations in the market, statistical analysis always has a way out. So if there's a problem, there's also a solution. That's what these videos are for, to keep you as a trader ahead of the crowds and join my journey into trading profits. On this cheerful and optimistic note, my friends, I bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Good, bad, or ugly, I'd love to hear from you in the comment section. Give me your feedback about what you think about this video. And hey, help me reach out to fellow like-minded smart traders like yourself by referring my video to your WhatsApp groups, your social media groups, family, and friends. Thank you for your patience. Till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Bye-bye.